So here what we have is that Rohan doesn't have $200,000 to give right away, but he decides that he really would like to be able to leave something upon him passing away. So he assigns a brand new policy. So he goes out to an insurance company and purchases a $500,000 life insurance policy. Now, most of the times it is permanent insurance. In other words, it could be T100. It could be whole life non-par, whole life par, it could be universal life. In other words, any permanent product would do. Generally speaking, term insurance is not really advisable here because, as you know, with term insurance, it has an expiry date. So if it expires at age 75, the policy is kind of useless at that point. And since none of us know when we're going to pass away, generally speaking, it is a good idea to buy permanent insurance if you're going to do that kind of thing. Not that the charity will frown at the term policy. All we're saying is that there's a possibility that at the end of the day, there may not be anything there because you've outlived the term period. So generally speaking, permanent insurance is really what's necessary. Okay. Anyway, so let's assume he buys a $500,000 permanent insurance policy. And then at the same time, once the policy is issued, all that, he absolutely assigns, remember that, got to be an absolute assignment. You're giving that policy away, basically, to that charity. And the premium is $12,000 a year. So he agrees to pay $12,000 a year. So from a tax perspective, okay, the charitable contribution will be $12,000. Okay, so basically what we're saying is that purely from a tax perspective, he can now deduct $12,000 because that will be essentially a charitable contribution. So even though the charity isn't really receiving $500,000 because he's not dead yet, there is, of course, the possibility in the future that he will die, obviously, at some point, and therefore they will be the beneficiaries. Remember, when he's assigned the policy on an absolute basis, now they own the policy, and of course they'll name themselves as the charity, okay, beneficiary and everything. And so therefore, the $12,000 premium will be considered a charitable contribution. And so then when Rohan dies, the $500,000 gets paid to the charity, and that's the end of it. Now, please note that the $500,000, there is no tax relief at that point. Remember, they already own the policy, and so therefore they name themselves as beneficiaries. So that death does not produce a tax receipt for $500,000. All they got, all that Rohan had is while he was alive, every year as he's paying his $12,000, he will get a tax receipt, so he can use that while he's alive. But that's as far as it goes, okay? But the $500,000, that will not be a charitable contribution at all because the policy is already owned by the charity. So it's not that they're receiving benefit after death. They already received the benefit prior to him passing away. So the $500,000 will not attract any kind of a charitable contribution. But the premium that is being paid every year, that will be considered a charitable contribution.